Ladies and gentlemen, good morning. My name is Eric Peterson. I am a partner at A.T. Kearney, and I'm also managing director of our Global Business Policy Council, an internal think tank for A.T. Kearney that is the sponsor of the Foreign Direct Investment Confidence Index that brings us together here today. I'd like to welcome those of you here at the National Press Club in Washington, D.C., as well as those of you around the world who are joining us with this live feed. It gives me great pleasure to welcome you to the event this morning and very briefly to say one or two words about our Global Business Policy Council. In 1991-92, under very different economic and geopolitical circumstances, A.T. Kearney, under the leadership of Paul Laudacina, who I'll be introducing momentarily, created the Global Business Policy Council to help leaders anticipate and plan for the future. It was a vital task then, and I think we can all agree that it's a vital task here today. And I know that a number of distinguished participants in this audience here this morning, certainly that resonates with you as well as those of you joining us by internet. The GBPC, as we call it, does three things. First, we generate research. We have done a number of cutting-edge documents over recent years, and I'd like to acknowledge Courtney McCaffrey, who is the lead author of our Foreign Direct Investment Confidence Index, and she'll correct us if we get things wrong here today. In addition to the research, we convene global forums bringing together political and business and other leaders to think through the big issues of our day. And then finally, we're proud to work shoulder to shoulder with our management consulting colleagues around the world in a whole range of strategic foresight functions that we think brings value to the kind of work that A.T. Kearney does. So with that, I'd like to offer a very warm welcome indeed. And now it's my great pleasure to introduce the chairman of our Global Business Policy Council, Paul Laudacina, who is also the former managing partner, CEO, and chairman of our firm, and is also a partner, and really he's the George Washington of our council. So Paul, with that brief introduction.
Let me get my wooden teeth back in my mouth for that one. Thanks very much, Eric. Great pleasure to join Eric in welcoming you all with us here this morning for this 20th anniversary result of the FDI Confidence Index. We began the index in 1998, largely because we were looking for a leading indicator of likely future FDI flows. All of the world was very much focused on hot money, capital flows, which come and go at the click of a button based upon impulse and highly volatile. And there was no indicator other than actual flow indicators of foreign direct investment. And when the United Nations UNCTAD publishes their FDI flow numbers, they're published late. It's a lagging indicator because it takes about a year after the actual consummated flow before it could be registered. And given the decision period and the payout period of investments, investments take a much longer time to be consummated, direct investment. So in effect, what you're taking when you're looking at flow data is a snapshot of a target that began many years before. So it's not giving you a kind of real-time indication of how global conditions, the global policy environment, macroeconomic conditions, are affecting what we believe is the ballast of economic development, foreign direct investment. Because it obviously investors have to make decisions based upon long-term market judgments, and therefore we thought it was important to design a tool which would give us some forward-looking indication of likely future flows. So we designed the Foreign Direct Investment Confidence Index based upon interviews, survey interviews, with Global 1000 CXOs, many of them CEOs, but oftentimes decisions on FDI are made below, of course, the CEO level, to get some sense of their attitudes and intentions with respect to foreign direct investment over a 1 to 3 year period. So we have, since 1998, been doing this regularly. we are happy to share with you today the results of the Foreign Direct Investment Confidence Index. One caveat: investment decisions, foreign direct investment decisions, are of course based upon very lengthy investigations by corporate strategic planning and other corporate executives to discern what their corporate interests are and how aligned they may be with a given environment. But there is also very much a subjective factor that goes into investment decision making. And so what we're looking at is subjective and objective views, the views of chief executive officers and leading executives around the world of their intentions with respect to foreign direct investment over the next 1 to 3 years. So with that, I turn it back over to Eric to go through some of the results.
Thank you, Paul. If you would consult the screen, please, I'll try to take you through a few of the highlights of our report, a copy of which you have available to you and which will be on our website now that the embargo is finished. As Paul has explained regarding our methodology, this report is the reflection of a survey of business leaders from across the world. Therefore, it is the judgment, the aggregate results are the judgment of a broad geographic and sector swath of executives who, in their own context, play a key role in FDI decisions for their companies. This does not reflect the judgment of A.T. Kearney. Instead, it reflects the judgment of those who were surveyed. Now, this survey, as Paul's indicated, has a strong track record of picking up not only hot FDI destinations, but overall macroeconomic and business environment trends that are forming or beginning to form on the horizon. So before I go into the country rankings, let me highlight here some key macroeconomic and FDI trends that have been identified in this survey. Then I'll come to the exact results in terms of the FDI Confidence Index results for 2018. And then we'll invite two specialists who I'll have the pleasure of introducing after I'm done to a panel discussion. I'd like to encourage you to prepare your comments and questions as we speak. We look forward to having an active exchange here. So with that, let me touch on a few of the conclusions of the 2018 FDICI when it comes to macroeconomic and foreign direct investment trends. First, we saw last year, 2017, that investors were already more bullish about the outlook of the global economy. And that trend has persisted in 2018. You'll note here that the much more optimistic category has risen from 15% last year to 18%, the somewhat more optimistic from 45 to 48. I think the message here is very clear that in the end, investor optimism has returned after bearishness in 2016. About 60% of those investors surveyed were decidedly more optimistic about the economy than they were last year. That is a very significant starting point as we look at these results. Now, as we asked for a whole range of issues that we'll be touching on, we'll return to the theme of localization momentarily. But the upshot is that as we think about localization and the issues, the wild cards that are most likely to occur, we see that geopolitical tensions are at the top of the list for the 4th year in a row. Now, I think many of us here would find this result to be rather unsurprising in the light of the headlines. But nevertheless, when you look at the number of items that we probed, including commodity prices, issues and regulatory environments, both in emerging and developed markets, it's significant that yet again it is at the top of the list. Now, you'll see here number 2 is rise in commodity prices. And here, again, it's not too much of a surprise. 32% of investors view this as likely compared to 26% last year. This is corroborated by a number of other sources, including the World Bank's most recent commodity markets outlook, which suggested a strengthening of commodity prices further through the remainder of the year. That covers, as you're fully aware, the full range of commodities from crude oil prices to metal prices, et cetera. Now, if we look at the whole notion of perceived risks and the number of the elements that, the attitudes that investors have to either increase, keep constant, or decrease FDI, we see in effect a very significant change from last year to this. Last year, as you can see, a whopping 52% suggested a potential moderate increase and 23% significant increase. And as we look at the 2018 responses, they're even higher, some 79% in those two categories, significant and moderate. What this means is that, especially as we will suggest momentarily, that when we look at it through the lens of localization, that investors are showing a shift in their overall perceptions. Now, what are the elements? What are the pathways for FDI strategies? Greenfield, joint venture, M&A, or a combination of all of the above. What we're seeing is the idea of a one-size-fits-all strategy is a thing of the past, at least so far as the current numbers suggest, and that we're seeing more of a customized approach. We see, in effect, a combination of methods or a portfolio when it comes to dealing with a whole range of ways that companies typically engage in FDI. Now, localization. What is localization? Well, we look at localization as a means by which companies customize their operations for the local environments within which they operate. And here, as we think about this phenomenon of localization, and we'll be issuing a major report on the phenomenon later in the year, we're seeing that in the end, a whole range of significant outcomes with respect to investor attitudes. Here we see on the left in the pie chart, 32% of survey respondents are currently exploring localization options. Another 20% are implementing those practices, and another 15% still have already implemented localization practices. And we think that probably this will increase even more in the future. Preferred mode of FDI on the right, you'll see that greater reliance on M&A JVs. This is the all of the above proposition that we talked about earlier, and also a rifle fire rather than shotgun with respect to approaches in terms of investing. Now, you'll note in the report that has been distributed to you that we have a number of questions that we've targeted on NAFTA. And we wanted to highlight one significant result. You'll want to look at all of them, of course. But we asked respondents, to what extent would termination of NAFTA affect your company's cost of operations? And the results, we believe, are very instructive. Some 60% of investors believe that it would either significantly or somewhat raise costs, while 17% think that there'll be no change in costs, and 23% believe that it might serve to reduce costs. So with that by way of overarching points that we thought might be of interest, now let me come to the specific rankings for 2018. And here, with a little fanfare, they are. You'll see, first of all, that the United States again tops the FDI Confidence Index, holding its first place position for the 6th year in a row. And the top 5 countries on the index remain unchanged from 2016 and 2017, although their relative positions have shifted. Notably, we see China dropping to 5th place this year, which is its lowest ranking in the history of our index. Canada jumps 3 spots to 2nd place, its highest ever ranking on the index. Germany comes in 3rd, with the UK, France, and Japan, each holding steady at 4th, 7th, and 6th places respectively. Australia improved by 1 spot, while Switzerland and Italy each surged 3 positions to round out the top 10 of our list. I should note that this is the first time ever Switzerland has been in the top 10, and the first time that Italy has been in the top 10 in more than a decade. Now, below the top 10, we see some steadiness in the rankings, but also some significant movements that I'd like to highlight. New Zealand makes the largest gain this year, rising 7 points to the 16th ranking. And Brazil, for reasons that I think we understand, suffered the largest drop for the 2nd consecutive year, falling 9 spots to the 25th place. A final point that I'd like to make on the top 25, and on which I will elaborate briefly in the next slide, is that we have 3 newcomers to the index. They are Denmark, Portugal, and Norway. In the case of Denmark and Norway, they've been on the list before, but they've been off, and now they've reappeared. And Portugal is a first-timer when it comes to the top 25 ranking. Now, what are some of the key takeaways? We'd like to highlight a couple of them. The first is, and this is very important, that developed markets are surging to their highest ever position in the index. This is quite significant. If you look at the long list, the list of 25, 21 of them are developed markets. And this is consistent with our results over the past few years, but it's especially notable because developed markets have ceded some spots to emerging markets in last year's index. So it came not as a surprise, but a matter of interest to us. Another key trend that we see in this year's index is that Europe is making a significant comeback to claim 14 of the top 25 slots. We believe that this reflects the range of factors, including the recent economic dynamism in Europe. But we also think that the looming reality of Brexit is motivating some investor interest in the rest of the EU member states as companies seek to maintain their preferential access to the EU market. You'll also note that Italy and Sweden have significantly improved their rankings over the past 2 years. And we believe that the broader, strong macroeconomic performance of Europe could signal an FDI comeback after flows to the region declined 26% from 2016 to 2017. Now, I mentioned the 3 newcomers, Denmark, Portugal, and Norway, and they round out this year's 14 European countries that are part and parcel of this list. Now, we looked at both positive and negative attitudes with respect to a number of these countries. And you can see that for most of these large developed markets, that's including Europe, but beyond that, we see a significant optimism, especially as you would guess at the top of the list. But we wanted to highlight on the bottom the 19% negative on Brazil and 23. And we see with respect to the UK, you'll notice that the level of pessimism we picked up was the highest at 22, although in net terms, it brought it up to 4th place from the bottom in terms of the ranking. But nevertheless, the jury is out clearly in terms of how Brexit is going to manifest itself. Now, when we look at these results from the prism of Asia-Pacific, the upshot is that developed markets in the Asia-Pacific region have fared quite well, but the emerging markets either held steady or fell somewhat. China and Japan are at 5th and 6th place respectively. Australia, as mentioned, improved by 1 place from 9 to 8. India has held relatively consistent 9, 8, and now it's 11. Singapore 12. New Zealand, as mentioned, had a significant rise. And finally, an 18th place for the second consecutive year, we have South Korea. With that, we thought that we would do a little bit of a deeper dive with respect to points of view that may help us explain these results. And to that end, I'd like to invite Laura Dawson and Paul Laudicina to come up here as I introduce them both. We're delighted to have, please come up and I'll introduce you as you come. Laura is director of the Canada Institute at the Wilson Center. In the past, she has served as senior advisor on economic affairs at the U.S. Embassy in Ottawa. She's taught international trade and Canadian-American relations at the Norman Paterson School of International Affairs. She is emeritus advisor at Dawson Strategic, which provides advice to business on cross-border trade, market access, and regulatory issues, and she has clearly a number of things to take on in that respect. She's a fellow at the Canadian Defense and Foreign Affairs Institute and serves on the board of the Council of the Great Lakes region. So Laura, we're especially delighted to have you here. I've already introduced Paul Laudicina, but he's been, zooming back, he's been 30 years of global consulting, working with leaders of corporations and governments across the world. I can say on behalf of the GBPC team that it is impossible to keep up with him, even in his current chairman status, where he has a number of responsibilities that go beyond our council. So we're delighted, both of you, to have you here for your reactions. Laura, we thought we'd ask for about 10 minutes, then Paul about 10 minutes, and then please, folks, prepare your questions and comments, and we'll open things up. Thank you very much.
Thank you. Mic working okay?
Yep.
Eric, Paul, it's great to be here. Thanks to the whole team at A.T. Kearney. I think the report that these folks put together is exemplary. They've done a really good job of providing a report that's wide-ranging, that shows you trends, but is comprehensive and manages to also give you a deeper dive in some of the critical areas. So it's great to have that as a point of departure. At the same time, I think my value added, or maybe what I'll contribute here, is really focusing on the second verb or an adjective in the title, the investing in a localized world. And talking about what's going on with NAFTA and what's going on with Canada, the U.S. largest trading partner and a small open economy that is incredibly dependent or vulnerable to the ebbs and flows of U.S. policy. I think it might be a good case study to look at what might happen next, or if there's a subtitle, a global recovery is a terrible thing to waste. So when I looked at some of the things that they've been putting together, and I lined them up against some of the things that I've been working on, primarily in the NAFTA. Lately I've been eat, sleep, drinking NAFTA, but also looking at issues to do with Canada's broader competitiveness. I mean, when you look at those numbers, Canada's had a great recovery and it's had great confidence. And who doesn't love Canada? Clean, green, handsome prime minister, good socks, all of the things that Canada is the Boy Scout country in the global economy. But what you don't see in surveys taken a year ago, 2 years ago, is that Canada's really struggling right now, and we may see those numbers start to decline. I mean, I don't want to be the skunk at the garden party, but the actions of large countries in the economy do make a difference, not only in the policy effects on your neighbors, but also in your own country, Canada, Mexico, New Zealand, in your ability to respond to those changes. I mean, when you see growth and you see forward motion, you think, oh, great, high cotton, offensive interests. I'm going to grow. I'm going to make hay while the sun shines. And you're not thinking of your defensive interests. And even if you're thinking of them, translating those defensive interests, those market signals that you're feeling, and translating them into government policy, the policy lag time is so long. And so this is the kind of turmoil and churn that I'm seeing in Canada right now. So in terms of some of the external threats, I mean, the obvious one clearly is the global move towards protectionism, nationalism, look after yourself. I I mean, don't you remember? I mean, some of you are too young, but back in the late 90s, we were talking about the free trade area of the Americas. Even before then, we were like, good neighbors, good trading partners make good allies and good democracies. Go negotiate a free trade agreement with an emerging market, and you're going to have a strong partner forever and ever. That's where we were in 1994, the formation of the WTO, 1999, free trade area of the Americas. That's definitely not where we are now, where countries are not playing fairly in the global trading system. We want to get what we're entitled to. We've been giving for far too long, and now's the time to get. We got to increase the border, increase the impact of the border. Well, for small, open economies, the bigger the border, the more difficult it is to do business in that country. Canada and Mexico do best when the border is negligible, when it is just like a domestic transaction. The more that the border effects kick in, and I'm not just talking about clearing a product at a physical border, although that's a big part of it, but the more that there's regulatory difference, the more that there's the possibility for unilateral action that'll cancel a transaction, like a dumping, anti-dumping claim, that sort of thing. The more that border has an effect, the worse off your small, medium, open economies are. When you lower the border, things are better. So some of the external effects on Canada right now have to do with changes in the economy due to the Trump government. Trade is the largest one, of course. We're going to rip up the NAFTA. We have ripped up, or at least defected from the Trans-Pacific Partnership. That's had a major effect on Canada. Yes, Canada and Mexico both did want to renegotiate that deal because it was a senior citizen trade agreement from 1994. It did not reflect third-party logistics. It did not reflect a lot of disaggregated production and supply chains. It certainly didn't reflect the digital economy. So we needed to update that deal. Canada got what it wanted, just not under circumstances it would have chosen. So look at some of the things that we call the poison pill issues that are in the current U.S. proposal for the NAFTA. The sunset clause. If you're an investor and you're looking at a market where the fundamental basis of the trade agreement could dissolve after 5 years, where the NAFTA goes after 5 years if the U.S. decides it's unhappy with the deal, why would you invest in that country? Government procurement. Government procurement supply chains are incredibly important in the North American context. And yes, buying local is great politics, but it's bad economics. And for example, in the water and wastewater sector, large municipal projects, Canada supplies a lot to the United States, but the United States supplies a lot to Canada. So if suddenly you can no longer use that range of North American contractors when you're only buying local, yes, that may preserve a few local jobs, but it's really going to upset your cost structure. It's going to slow down projects. It's going to slow down contracting. It's really going to throw sand in the gears. That's what a lot of these new measures or proposals are doing to the U.S. economy, in that they look good because you're making that border bigger and keeping those pesky neighbors out, but it's throwing sand in the gears. It's disrupting existing supply chains, making it more difficult to do business. The rules of origin in autos issue that the folks have been wrangling over, ministers and negotiators have been wrangling over for the last, months, but most intensively over the last couple of weeks. It's incredibly complicated, and they may find a way to shift some production back to higher wage jurisdictions. And we get that is to the good from President Trump's perspective. But the way to do that is so many different ways of assigning credits and benefits for this much investment in R&D, and we have to ensure that everyone at this workshop in Chihuahua is making at least $15 an hour, and we have to monitor and enforce that labor and wage claim there. The compliance costs of these new protectionist measures are huge, and they're going to really affect our ability to do business in a North American plant that is functionally interactive, where the costs are low, regulations are aligned, and the border is minimal. If the U.S. proposals are successful, we're going to end up with a North American plant that is much less effective, much less competitive in the world. And so what we're seeing a lot of investment already We're not seeing the numbers yet. We haven't been able to track the numbers, the investment shifting from Canada to the U.S. But we're hearing anecdotally from investors, they're keeping their hands in their pocket until they see what happens next. They're certainly diversifying. They're hedging their bets, because if you are in one of those procurement by American supply chains, you are diversifying your production out of Canada and at least establishing an operation in the United States. Similarly, if Donald Trump closes the border to movement of workers, what do? You need to move your workers to the United States. So darn it all, his policies are working. We're saying, well, you can't let a bully win. You gotta stand up to a bully. But from a cost and supply chain perspective, you've got to go where the forces are pushing you. So we're seeing Canada and Mexico and other countries trying to adapt to these changes. I'm talking to other trading partners of the United States, and they're saying, we're just not prepared to have further discussions with the U.S. right now. I know that this government wants to do bilaterals with the world, but gosh, that United States, they're just a handful. We're going to wait until there's more certainty in how to manage this relationship. Because if they're kicking the heck out of their closest friends and neighbors, how are they going to treat other countries? So there's that. Meanwhile, there's Canada trying to adapt to these changes, not only in its negotiation strategy, but also Canada's policies were lined up for a Hillary Clinton-like presidency. So Canada was preparing a very clean, green emissions reduction strategy that raises the cost of carbon in Canada. That doesn't work so well when the gap is getting bigger. Not only is the gap getting bigger on carbon prices, but on taxes. With the U.S. tax reform, the combined tax rate is lower, somewhat lower in the United States than Canada, just a couple of 0.5% or so. But the U.S. is also given 100% write-off on equipment and machinery. Canada does not offer that. Where would you invest? I would invest where I can get the full write-off for my investment. So there we are. So in the last minute or so, because I know there will be more questions, let me give you my insights into where we are with the NAFTA. Anything I've got right is because I get to hang around with negotiators once in a while and talk to businesses, and because I taught this stuff for 20 years, so I know how the other negotiations have gone. Anything I get wrong is entirely my fault. The NAFTA cannot be concluded effectively in a week. The substantive deal cannot be concluded in a week or a couple of weeks or even a couple of months. There are 6 chapters that are concluded, that we know are concluded. We may be close to conclusion on 10 chapters. There are 32 chapters in the deal. It may be 31, it may be 33, it may be 30, but we are not even a third of the way there. Plus, what has been concluded are mostly the super easy stuff, the things we already agreed to in the Trans-Pacific Partnership. Anti-corruption, who's the pro-corruption force there? Support for small and medium-sized enterprises, absolutely, why not? Transparency measures, okay, good, yay, good on transparency measures. Some regulatory good practice. We've got all the happy talk chapters relatively agreed on. We've got this middle set of chapters that are just hard work. They are about updating an old agreement and reflecting new regulatory and border practices in services and market access and agriculture, the day-to-day grind of how we trade. We've got the sort of greatest hits issues that we're always going to disagree on. Canada's got dairy, U.S. has got the Jones Act. If you don't know what that is, look it up. Mexico's got a number of issues that are sensitive for it, and that over time, we reduce the barriers in these areas. And then we have another set of issues called, some people are calling the poison pills, which seem to be designed to kill the deal, or at least give the U.S. maximum leverage, because if you don't do X, then we're going to implement the sunset clause that kills the deal after 5 years. A government procurement offer that is worse than the government procurement offer we had in 1994. Rules of origin in autos that are so complex and so punitive that no North American manufacturer can meet them. A complete gutting of the dispute settlement process, which means if the agreement doesn't work, you don't have recourse to challenge that agreement, etc. So these are issues that Canada cannot just accept, or even watering them down. It's like, okay, do you jump halfway off the bridge? Maybe. So where are we now? We are talking about an agreement in principle. I'm skeptical about the agreement in principle, because even if they get something strong on automotive. You can't go back home and say, hey, we're so convinced that this agreement on autos is terrific that we're going to stipulate to a great outcome on agriculture and timber and forestry and services and banking. You just can't do that. You've got to get through more than 6 of 32 chapters. We have the political realities of the U.S. congressional midterms and the Mexican presidential elections. So do you continue to negotiate formal rounds through that? Do you suspend negotiations? Do you try to do technical working groups on the side? I don't know, and I don't think those guys at the Winder building, where USTR is based, know either. So we're sort of in this betwixt and between. I don't think the president is going to abrogate the deal. I think he may launch a U.S. withdrawal, but I don't think he wants to finish it, to the extent I can read Donald Trump's mind. There's too many U.S. domestic interests that have said, especially the farm sector, don't do it. Don't screw this up for us. You can tweak it, but losing the NAFTA is far too detrimental to U.S. manufacturing and agriculture. So he may start it because, look what I can do, but it'd be very, very difficult for him to complete it, and I'm not sure he wants to complete it. So we are going to be in this state of what I would call zombie NAFTA. It's neither alive nor it's dead. We have NAFTA 1994 to rely on, but in the meantime, we are telegraphing all sorts of uncertainty to the rest of the world. As we are shooting each other across the neighbor's fence, the rest of the world is carrying on, finding new ways to be competitive, new ways to reduce the border effects, new ways to reduce transaction costs, and we are going the other direction.
Laura, thank you very much. Very interesting comments, and I'm sure they'll inspire a number of other comments and questions from this audience. Now, Paul, if we could get you to kind of zoom back and look more internationally at these results that we have, and you have the long view, of course, the benefit of the long view.
Sure.
How do you see things unfolding?
Sure, I'll be very brief so we can get into a group discussion. But, and thanks, Laura, for those comments. Zombie NAFTA, that's something that will stick in my mind for a while. It's a little bit like Back to the Future. In the early days of the FDI Confidence Index, which were some of the heady days of globalization back in the late 90s, FDI was a tool for integrating value chains. Companies were transnational, and they had dispersed operations all around the world, and FDI was an important tool for globalizing the company. 2.5 years ago, Eric and I released a report at the World Economic Forum meeting in Davos that we produced called From Globalization to Islandization, where we telegraph what we thought was a clear retreat from globalization and a movement toward more balkanized, islandized, localized global macroeconomic policy impulses. And the Davos community all shook their heads and said, you guys are smoking something. That's crazy. I mean, globalization is irrefutable, immutable, irreversible, irrepressible force. And then this year, of course, everybody was talking about the demise of globalization. And foreign direct investment as a tool, and that's what this report is all about, that sort of the title page graphic with what looks like that dinosaur paw, with the local roots of this big trunk of macroeconomic activity. And we saw in the results that Eric shared with you that almost 90%, 89% of investors said that they're pursuing localizing strategy, shifting management, operations, production, marketing to local markets. And so by Back to the Future, I mean, if you look at the history of the development of the corporate structure and enterprise, back in the 20s and 30s, we went from, because of the impulse of protectionism and exchange controls and all of the other developments that led to the Great Depression, companies began using foreign direct investment as a way to move operations, manufacturing operations, if you will, behind enemy lines into localized markets. Before that time, international companies imported raw materials, manufactured them, and exported finished materials. So we have now, because of this impulse of protectionist, populist, nationalist government policies, we have governments or companies looking for ways to get out and have their production again through the medium of foreign direct investment in local markets. So curiously, paradoxically, FDI becomes still a tool for integrating and globalizing, and at the same time a response to market restrictions, providing local access to markets that otherwise might be difficult to access because of nationalist policy impulses. So that's one important finding that I think it's good to keep in mind about these results. Secondly, Eric already reviewed the fact that 84%, an all-time high of the top 25 destinations for foreign direct investment, preferred destinations over the next 1 to 3 years, are in the developed world. And in fact, we only have 4 of the 25 in emerging markets, China, India, Brazil, and Mexico. And as Eric pointed as well, Europe comprises 14 of the top 25 spots. So what we've got here is a movement which we've been seeing over the last couple of years back to developed countries and away from developing countries. And to put it in historical perspective, if you look back at our results from 1998, 99, the early years, the top 25 were very much populated by developing countries. And even by some frontier markets, because those were the market opening, halcyon days of exuberance, irrational exuberance about the global economy. And so it was lots of opportunity, and that's FDI was a tool for that. Today we see this movement toward developed markets for a number of reasons in our view. First, of course, there is strong synchronized economic growth that's returned to the world generally, and especially to developed markets that haven't been strong growth engines in the past. Secondly, the importance of technological innovation as a driver of competitiveness. And to the extent that developed countries have the wherewithal to be more technologically innovative, they become more important destinations for investment, especially in a less labor-intensive and more capital and technology-intensive environment. And thirdly, of course, the regulatory pressures which various governments are exerting that create an impulse for countries and companies to want to be in those markets. So curiously, you see the results. The United States is at the top of the list for foreign direct investment, not just because the size of the U.S. market and the robustness of economic performance, but also because some companies are doing the math and saying, what if we're not able to access that market the way we have historically? Let's have more of a presence in that market so we can access it. The other point I wanted to stress is that we have this curious juxtaposition of bullishness about the global economy, where 2/3 of the respondents said they're more optimistic about the global economy this year than last year. But at the same time, they're bearish, and Eric went through the risk factors about policies and politics. So how can you have bullish economics and bearish politics and say you're going to be investing more abroad? And when you look at the bullishness, investors are most bullish first about Asia-Pacific countries, secondly about Europe and the whole Eurasia region, and then about the Americas. They have a mixed view about the Middle East and North Africa, and they have a decidedly negative view about sub-Saharan Africa. South Africa, for example, which used to be on the top 25 fairly consistently off and on, isn't this year, hasn't been for a number of years. And if you look at the issues about transparency and corruption and so forth, certainly with the Zuma regime, there was concern that investors had that it was off bounds for a while. Now with Ramaphosa, we will probably see some change. Brazil dropped to 25. We know what Brazil has been going through. So there's a lot of volatility, and all of these policy risks have increased over the last 4 years. This is the 4th year in a row there's been an increase in this concern about the policy. So I guess, F. Scott Fitzgerald used to say the test of a first-rate mind is how you keep 2 opposing point of views in your mind at the same time and still are able to function. Well, that's what essentially the global economy is doing right now. So we saw as well another anomaly that in 2017, FDI flows actually declined fairly dramatically. How is that when last year we were saying that there was bullishness about the global economy, this year we're saying it again? Well, one of the things to note is the deal flow, particularly in the United States and the United Kingdom in 2015 and 2016 was at an all-time high, and this year it's kind of back to normal. So in 2017 there was a decline in FDI flows at the same time that countries and companies were bullish about the global economy. One of the things that's true throughout this result is that investors tell us that they're uncertain about where to invest. They're bullish about the global economy, they like synchronized growth, but because they look at the political risks and they worry about the volatility and what might happen. Here you have an expert, Laura Dawson, telling us zombie NAFTA. Who knows? You know, one throws up one's hands. What do you do in that kind of environment? You tend to sit on your money. And so we have these two phenomena coexisting, and I think that's probably going to be steady state as far as the eye can see. So I just want to put those things on the table, and I think now we should kind of open it up.
Good. Why don't we open things up? Will you please identify yourself before you ask your question or make your comment?
Good morning. Thank you for this.
Good morning.
I would like to ask. Thank you. I'm Luis Alonso with the AP. Good morning. And I would like to ask you guys about Latin America specifically, because that's my audience. So I need a region target answer. I see that Latin America is only one of the two regions that increased FDI in the past.
Yep.
So I would like to ask whether, given all the factors in place here, the elements in place, is the most likely scenario that you guys see is, will the FDI to LATAM keep the same upward trend in the near future? And what will be the impact of that trend for the regional economy? Thank you.
Let me start, if I can, and say that, first of all, obviously, the big elephant in the room in Latin America is the Brazilian economy. And as long as Brazil is at the bottom of the rankings, it's hard in the aggregate for Latin American flows to really increase dramatically, because Brazil is such an engine of growth. But there are other things in the region. Obviously, Argentina is a more attractive environment than it's been, even though it's not in the top 25. Mexico is a question mark, because we don't know what's going to happen in the elections. Venezuela, of course, is a continuing source of concern to everyone who looks at the environment. So, yes, you're right. Last year, Latin America and the Caribbean was one of the only regions in the world that had modest increase in FDI. But since then, and remember, that was a snapshot of things that were going on 2 years or more before in terms of investment decision calculus. But currently, the things that one sees in Latin America reflected in the rankings, with Mexico holding steady before López Obrador was up in the polls as he is now, because we were in the field in January. And with Brazil at the bottom of the barrel, it's hard to imagine over the next 1 to 3 years, if those situations don't improve somewhat, that FDI flows in the aggregate could go up much more than they have in the recent past.
And I would just add to that the importance of staying the course. Good policy is good policy, even if your neighbors are having a bout of temporary insanity. I got myself quoted in Latin America on that one. If you look at the market opening and liberalization policies of Mexico over the past 20 years, they really have been exemplary. Mexico has more free trade agreements than I think any other country, certainly any other country in the hemisphere. Just concluded a deal with the European Union. Open markets and market access and regulatory alignment continues to be a very good and strong policy. If you don't have the other option of being the elephant in the economy, then you have to find ways to, again, reduce transaction costs, reduce the impact of barriers. And we do see that the strongest economies in Latin America are those that have been pursuing an open, progressive, liberalizing agenda with the neighbors.
Let me add a point, if I may. Chairman's prerogative. Building on what Paul said earlier, if you look at the performance of Brazil over the years on the FDICI, it does snap back quickly when it faces adverse political or other circumstances. And it's possible that we may be seeing that again sometime in the future, assuming they and others can cover some of the issues that have been highlighted both by Paul and Laura. Please, in the back.
Thank you. I'm Jan Böscher with German Public Radio. I have a question for number 2 and 3 in your ranking. Number 1, we're hearing about zombie, NAFTA. Why is it that investors still like Canada so much and even push it up in the ranking? And looking at number 3 in Germany, what are the problems Germany should address for being perhaps number 1 one day? Thank you.
You do Germany, I'll do Canada. But you do Germany first.
Start with Canada.
All right.
Okay. Canada continues to have very strong fundamentals. Canada continues to be one of the most stable, transparent places in the world you can invest. You know exactly what you're going to get with Canada. There are not strong shocks in any direction. It is a strong, very strong resource and commodities-based economy, so if you're interested in that. But it also has extraordinarily strong investment in human capital, healthcare, social programs, etc., but also investment in new initiatives, new industries, AI, green technologies, etc. So it's trying to sort of make up for any economies of scale gaps it might have in manufacturing by jumping to a digital economy as well. So it is a very strong long-term investment. It's going to be very stable. It's got great policies towards immigration. It's dealing with its baby boom skills and workforce deficit by importing good thinkers and brains from all over the world. So in the long term, it's a great investment, but short-term volatility causes it pain.
All right, and turning to Germany.
Yeah, I mean, Germany, of course, is doing quite well. It has consistently been among the top 10 over many years. In fact, last few years, vacillating between second and third spot. That's not a significant difference in terms of ranking. It's all about relative ranking. Really, I think Germany's assessment as an investment destination, much like Canada's or Mexico's, even to some extent the U.S., is dependent upon what happens with the internal market dynamics. Investors tell us consistently that they like to invest in markets that are robust economically and that have depth, that the market is large enough, or as part of a regional alliance where you have market access. So the strength of the European community and Germany's position in it will largely determine, I think, going forward, how strong Germany is as a destination for foreign direct investment. Now, you know the flow numbers. 2015, you were at $33 billion, and you go back, that was low. You go back to 2011, Germany was 67 billion, 65 billion, 2010. So there's been a lot of bouncing around. Probably has more to do with deal flow than it has to do with intrinsic attractiveness of the marketplace. The strength of the government in Germany as a kind of antidote to all of the other kind of populist pressures driving some of the politics, not just in the region but globally, will continue to be a beacon to investors. But the uncertainty about the political environment and leadership in Germany and the cohesiveness of the European community has got to be, to some extent, a little bit of a drag on that. But remember, Europe performs exceedingly well in this survey result, as does Germany with it, the largest market, of course, in the community. So I think it's a good result for Germany, and as long as Germany keeps behaving in the future as it has in the past, it will continue to do well.
And the FDICI in the past has picked up dynamism in Europe and in Germany in particular. It's been a forward indicator in the past, and I think that this certainly augurs well for what's happening in the country.
Well, and just to talk about volatility, I mean, we were talking about the demise of the European community a few years ago. Then everybody was wringing their hands and gnashing their teeth over Brexit, and now Europe has got synchronized growth again. I mean, this is the Geiger counter that creates whiplash, which makes it difficult for investors to decide that they want to invest capital for long payout periods.
I'm overwhelmed here. Geiger counter, whiplash, zombie agreements. There's a lot going on here. Please, please.
Thank you very much. Kearney Bearish from the Embassy of Japan. I want to ask you a question about the response about the effects of withdrawal from NAFTA. according to Eric's presentation, 60% of respondents said that the withdrawal from NAFTA would increase their cost. But if I remember correctly, 23% of respondents at the same time actually said that that would lower the cost. And what do you think the reason for that is? And do you have any
Temporary insanity.
do you have any anecdotal evidence as to the effect of withdrawal or changes of NAFTA to business cost?
You want to start with that?
Laura, yes, the numbers are ours, of course, but I'm sure that
I'm
you have
defending
a good reason to.
Well, I don't want to say temporary insanity, but I think perception is incredibly important. And the president campaigned on a platform of NAFTA and trade agreements being bad. So for decades, we have heard NAFTA is a dirty word. So not everyone understands the effects. Now, there is no way that abrogating the NAFTA can reduce anyone's costs. It can shift production to the United States, certainly, and it could increase demand, but it's not going to reduce costs because the costs of inputs are going to be higher if you cut your supply chains. Now, perhaps you can cut your own employees' wages and you can cut your own labor costs, but I find that a stress. So this is what people are perceiving, and perception becomes reality. So people act on those kinds of perceptions. Can I take 30 more seconds to talk about something else, which is not the question you asked, but because you're
Sure,
there.
and we've got 3 minutes left.
Okay,
so last word.
it'll only be 30 seconds. TPP, CPTPP, Trans-Pacific Partnership. Two things. First of all, Japan's leadership on the Trans-Pacific Partnership has been extraordinarily important. Had Japan decided to defect from the Trans-Pacific Partnership and do a go-it-alone deal with the United States, the other TPP 10 countries would have been in really, really dire straits, because it's been, the Japanese market access that has been the desirable thing there. Secondly, when the U.S. left the TPP, not only did we collectively, the other TPP countries, we cut out 20 key U.S. provisions in that deal. So when Donald Trump talks about coming back to a better and improved CPTPP, actually the TPP right now is U.S. minus. They have to put 20 things back in even just to get it back up to where it was a year and a half ago.
Thank you. Paul, do you have any last words before?
No.
We have, perhaps, if there's one burning question or comment, please. If you identify yourself and also keep your questions short.
Yeah, sure. Thank you. I'm Yan from China Daily. I have two very short questions. So first, the index shows that there is a 38% investors are more optimistic about China's economic outlook, but it also cited another report by the U.S.-China Business Council, which said actually 40% of the companies are less optimistic about China's economic outlook. So I wonder why there is a discrepancy between these two reports. Is it because they look at different indicators? So that's my first question. And my second question is, will the investors keep being bullish about China's economic outlook given the current political environment in China and the rising tensions between U.S. China in trade and in politics? Thank you.
Thank you. Thank you. Would you like to take
Yeah,
that
I
on?
mean, it's hard for us to discern why there's a difference in the result. Probably it has to do with the time that you're in the field and when you're surveying, because again, this is a kind of snapshot of sentiment at a given time. This is one of the paradoxes, that people could be bullish about an economy, but yet China has fallen in the index. In the early days of the index, between 1998 and 2001, China was not in the #1 position. The U.S. was. In 2002, 2003, this was the first year that we announced that China would be the #1 preferred destination. Everybody said we were crazy because the United States had 3 times the amount of foreign direct investment flow, so how could China be #1? And China maintained that position for 10 years until 2012, when the United States resumed #1 position again. So the ranking is, this is a forward-looking indicator, and you know, it's hard for us to say what it's going to mean in terms of flows, except the index generally tends to be a fairly good overall barometer of likely future flows. And the second part of the question, do you want to address?
Well, and let me say, in terms of this apparent contradiction, in terms of the narrative, we see these kinds of conflicting signals these days. But there are some things that are immutable about the China economy in much the same way that Laura's emphasized that they are on the Canada economy. We see remarkable growth, expansion, historical expansion over a protracted period of time. A remarkable movement of a range of factors, accelerated modernization of physical infrastructure, a range of other elements, including significant strides in education and human capital, all of which seem to be pushing the country and the economy up in the long range. So it was no surprise that it stayed at that top tier, and of course there'll be movement year to year. So these conflicting signals notwithstanding, I think that the message here is clear that that the world is bullish on the prospects for the China economy. All right, it's too fast, too much information to convey, great points of view to help us put things in perspective. But it falls on me now to thank you all for joining us this morning. We look forward to having more of your reactions as you look at the material in a little more detail. This, I should emphasize, is a snapshot. Paul has said that it was in the field last January, so that this is a continuing set of conditions. So we'll look forward to seeing what happens with zombie NAFTA. We'll look forward to seeing whether we can channel, as Christine Lagarde said, fixing the policy roof during the sunshine period, and that we don't waste, as Laura suggested, good synchronized economic growth to allow things to go the wrong way. So thank you all very much for joining us, and we look forward to being in contact in the future. Thank you.